Hey guys, in today's stock market, it's not easy finding a high quality stock that pays a reliable dividend, and it's also a relative bargain. But I believe I just bought one for our income builder portfolio. This stock's PE ratio sits well below its historic norm, and most analysts say it's undervalued. As a business, it's growing exponentially, going from a boring chain of drugstores to a healthcare conglomerate with great prospects for the future. And it's paid dividends without interruption or reduction for nearly 25 years. Hi everybody, I'm Mike Nadell, here for the Dividends and Income channel. If you like our content, do me a favor, will you? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Before I talk about the most recent buy for the Income Builder portfolio, I just want to tell you a little bit about my philosophy, because I've been doing these videos for less than 2 months, and you all don't know me that well yet. I'm not the kind of guy who tells you what you should buy or what you must sell. I don't pound the table for this stock or that fund. Look, I'm not trying to get you to buy a used Buick, and I'm not campaigning for political office. Here's what I do. I tell you about the investing decisions I'm making and why I'm making them, and I trust that you're intelligent enough to do your own research and to make up your own mind. I've been picking stocks twice a month for the IBP since 2018. The co-founder of this channel, Greg Patrick, allocates $2,000 every month for the buys. The IBP's main goal is to build a reliable growing income stream, and the secondary goal is to experience solid total return. I believe doing both is possible. The IBP now has 42 stocks. It's worth about $116,000, and it's generating almost $3,000 in annual dividend income. Remember, Greg and I aren't doing this to persuade you to copy this portfolio. No, we want to use the IBP as a way to discuss the process of portfolio building and to introduce interesting companies for further research. Companies like the one we just added, CVS Health, symbol CVS. We bought 12 shares on June 21st at $83.34 a piece. We'll get to the company's valuation in a couple of minutes. First, let's talk a little bit about CVS Health's business. Most American consumers already know that CVS is a sizable drugstore chain. According to the company, 85% of the U.S. population lives within 10 miles of a CVS pharmacy. But to call CVS just a drugstore would be like calling Scarlett Johansson's Black Widow character just another pretty face. After buying Caremark in 2007, CVS became a major pharmacy benefit manager. In 2015, the company greatly increased its footprint by acquiring Target's pharmacy and clinic businesses. And in 2018, CVS completed a $69 billion deal for Aetna, which gave the company one of the largest health insurance operations in the entire industry. The company's pharmacy services segment works mostly with employers, insurance companies, government plans, and health exchange plans. It offers plan design and administration, retail pharmacy network management, and mail order pharmacy. Its healthcare business division offers health insurance products. Among those it serves are employer groups, college students, part-time and hourly workers, healthcare providers, government-sponsored plans, and labor groups. Then there's the familiar retail segment. It runs the brick-and-mortar stores and pharmacies, as well as minute clinics within more than 1,000 of its stores. CVS also is growing its health hub concept, offering customers access to nurse practitioners, dietitians, and social workers. While all of that has made CVS a formidable conglomerate, the acquisition binge also substantially increased the company's debt load. The debt really had a huge spike in 2018 when the Aetna deal was finalized. Mr. Market, he doesn't like big debt, so that deal put a lot of pressure on CVS's stock price. In 2016, before the IBP was even a twinkle in my eye, I bought CVS for my personal portfolio. And the next several years, man, they were pretty ugly. Second guessing yourself, well, that's one of the fun parts of being an investor, right? And hey, the performance of my CVS position looks even worse when I apply some context. I'd have been bragging instead of whining had I bought a competitor like United Health Group, or if I just invested in the S&P 500 index. The Income Builder portfolio has owned a stake in United Health since June 2019, and we've added twice to the position. It's been a terrific performer, and I seriously considered simply adding to it again this time. But while United Health has become expensive, with a 21 forward PE ratio, CVS still appears attractively valued at 11 times forward earnings. That's even after its market-crushing climb of these past 8 months. That climb actually put my personal CVS position into the black for the first time in years, and I don't think it's anywhere near done yet. The company has improved its financial picture significantly by paying down debt, and as this financial sonar by Jefferson Research shows, CVS really has strengthened its balance sheet overall fundamentals. At its earnings presentation in May, CVS said it paid down more than $3 billion of long-term debt in the first quarter alone, and $15 billion over the last couple of years. Also in that report, executives announced outstanding results across the board, beating expectations for revenue, earnings, and operating income. The company also raised its full-year guidance, something investors always like seeing. As terrible as the pandemic obviously has been, it did create stock market winners and losers. CVS has been one of the winners, thanks partly to coronavirus testing in 2020 and vaccinations in 2021. More recently, the Supreme Court's rejection of a challenge to the Affordable Care Act figures to help the bottom line of CVS, United Health, and other insurers that participate in Obamacare. Okay, let's take a look at dividends for a second now. One of the things that attracted me to CVS in 2016 was its impressive dividend growth over the previous 15 years. But as the debt load grew, CVS couldn't really justify hefty dividend increases, and the decision was made to keep the annual payout at $2 a share. While the dividend growth investor in me wasn't thrilled with that, more than anything, I want the companies I own to be financially sound for the long haul. So I've been willing to accept this dividend freeze, and I've been relieved that the dividend wasn't actually cut, as many companies did during the pandemic. CVS boasts about its 98 consecutive quarters of paying dividends with no reduction, which I agree is pretty impressive. And despite the freeze, the stock yields 2.4%, almost a point higher than either United Health or the S&P 500. And with CVS improving its financial picture, many analysts believe the company will return to its dividend-growing ways in only a matter of time. CVS certainly has low payout ratios, suggesting it could easily handle a raise. The IBP's 12-share position is expected to generate $24 during the next year. The first quarterly dividend coming in will be $6 in early August, and that will get reinvested right back into CVS stock, a process known as dripping. Then in November, the new higher share total will generate slightly more income, and that'll be dripped too. We'll keep doing that, not only with CVS, but with all 42 of our stocks, as we work toward our income target, $5,000 within 7 years. That's how an income stream gets built, and that's why we call this project the Income Builder Portfolio. Okay, now let's get into valuation. Morningstar says the fair value of CVS Health is more than 10% higher than the price we just paid for the IBP stake. Another analytical firm, CFRA, calculates fair value at about $106 a share, so they think we bought the stock for the IBP at nearly a 30% discount. According to FastGraphs, CVS has a blended PE ratio of about 11. That's significantly lower than its 14-ish norm over the last decade or so. Most analysts out there are bullish on CVS. Of the 18 surveyed by TipRanks, 14 analysts say CVS is a buy, and their average target price suggests a 13% upside. There's a similar story with analysts surveyed by Reuters, with 17 of 26 giving CVS either a buy or outperform ratings. So again, I'm not screaming, CVS is cheap, buy, buy, buy. That's not my style. I'm saying it looks like a pretty good value now, and it's a high quality company, so it might just be worthy of your consideration. I'm not exactly turning cartwheels in celebration of CVS finally shedding its loser label within my personal portfolio. For one thing, I'm pretty sure I'd break several bones if I even tried a single cartwheel. For another, a compound annual growth rate of about 2% over 5 years, that's hardly a reason to celebrate. But you know what? Investing isn't about the past, no matter how bad or how good. It's a forward-looking exercise. And fundamentally, CVS Health appears to be on very solid ground now, and the stock's valuation suggests it still has plenty of room to run. Throw in its dependable dividend that looks ready to grow again, and I'm talking about a company I'm glad to have in our Income Builder portfolio. I'll be back in a week or two with another video about our next IBP buy. In the meantime, I'm always updating the portfolio's homepage on our website, so if you'd like to learn even more about it, check out the IBP link in the description. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.